opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, everybody. Welcome to episode 22 of the Macro Corner podcast, proudly presented by Blue Line Futures. I'm your host, Paul Wankmueller, my co-host, Jannis Meindl. Welcome to the show, Jannis.
Hey, Paul. How's it going today?
It's going great. We have tons of data coming out this week. Most importantly, the Federal Reserve meeting on Wednesday. But today's episode will focus on climbing the macro mountain, looking from the top, taking a step back. Let's see what's going on out in the economic world to prepare for this week.
Yeah, exactly. I mean, first and foremost, we do turn to treasury yields and the two-year yield in particular, which has remained extremely sticky around the 4.5% mark, that is. So as the Fed is trying to communicate a pause rather than a pivot, they're not going to pivot with inflation and CPI at 8%, but communicating a pause, they're facing a profound challenge that is a dilemma where the Fed needs to communicate that they're going to slow the pace of hikes, that they're not going to be as aggressive going forward, and at the same time not allow financial conditions to tighten to ease substantially, which they saw ahead of the Jackson Hole speech that Powell gave, which came out pretty darn hawkish because he didn't want to see those financial conditions ease to the extent that they did back then.
Right, and that 2-year has been above the 10-year, I think, beliefs since July, right? It's been up for a while.
Yes, exactly. It's been inverted since July on a sustained basis, and what that means is ultimately that the market is telling the Fed, and at this point, it's rather screaming at the Fed that a recession is going to be with us at some point in the not too distant future, maybe in 6 to 8 months. Ultimately, we will pay a lot more attention once this curve moves out of inversion again, because that's usually where the recession begins, and maybe where the recession playbook is going to be a bit more feasible than it is at the current moment. But also, more importantly, the Fed's sort of preferred recession indicator, which is the 3-month 10-year curve, which we had mentioned on past episodes, that one's also around inversion at the current moment. So the Fed is obviously trying to take all the information in, but as Nick Timiraos from the Wall Street Journal articulated over the weekend when he joined Face the Nation on CBS, he was really clear, and he's sort of the Fed whisperer at this point. He was really clear that the Fed does see the risk of moving the economy into recession as a lot less dangerous than letting inflation run hot and possibly move out of control.
Right.
And so they want to take the pain of recession over letting inflation spiral out of control.
Now, with regards to inflation expectations going forward, one thing that we do look at are the break-even rates. Let's go into that a little bit. What's been going on with that since the last time we spoke?
Yeah, exactly. So we did record a podcast episode that was titled Poking Holes in the Inflation Balloon. And in that episode, what we tried to articulate was that inflation expectations did roll over a couple of weeks back, and that sort of spurred a rally, especially in the NASDAQ. But since then, we have again seen break-even rates tick up a bit. And what that means is that maybe the markets are not yet responding to the 400 basis points of hikes additionally to quantitative tightening that the Fed is currently doing. So as those break-even rates move up, that's a little bit concerning from the Fed's perspective, given that they don't want to see those inflation expectations spiral out of control. That comes along with the Cleveland Nowcast, which is sort of a real-time measure of where inflation over the next month is going to come in. That basically takes all the economic indicators and puts it into a number that is then PCE, CPI inflation. And that number is also remaining extremely sticky, out above 8% on headline CPI. So the Fed will want to see those numbers roll over, and they're willing to take the cost of recession in exchange for bringing in inflation. Then again, the question is, to what extent do they have to slow the economy? As of right now, we do see that most of the economic growth is exclusively in services. We've
Right.
spoken about the shift from durable goods to services for quite a while, and that's what we're seeing right now.
Right. Two things there. I mean, our GDP is looking pretty phenomenal compared to a recession right now. It's fair to say that. And the number that's coming out on Thursday, the inflation number, which will show how much inflation has shifted into the services versus the durables, and it is in services versus the durables. That's a foregone conclusion. Am I right?
Yeah, so what we'll see on the ISM number coming out on Thursday is that on the services side, inflation has sort of shifted from the goods side to the services side. And what the Fed does not want to see is the same type of inflation on the services that we've seen on the goods. So as we're undergoing the shift, the question becomes how long can the consumer spending binge go on in the services, and how much of a detriment is Fed policy going to be on the lag? And as they're trying to fight inflation here, one would think that there will be a decrease in spending ultimately. I
Right.
mean, then you have this dichotomy between the recession trade, and then perhaps if inflation stays higher for longer, is where maybe nominal growth is going to stay high for quite a while. So that is ultimately a really difficult question to answer here. But
Right.
yeah, I mean, economic growth's been extremely strong, and this is not a recession just yet. Although real-time market indicators such as the yield curve are telling us that it will be there in the future.
Right. And I'm thinking that the consumer is just choosing to spend their money on services. We saw earnings last week in the airlines look really great. I believe that the major theme parks were able to raise their prices without a blink of an eye. So people are just spending on experiences versus consumable goods that might have made them happier in the past.
Yeah, I mean, certainly, as people have been sort of inside their house for quite a while. I mean, and not in the recent past, but
Right.
that was going on for a year and a half. People are a little less sensitive to higher prices, so maybe right now they're not as responsive to price increases on the services side. But ultimately, as they run down the savings, as they take on more credit card debt, one would imagine that some of that spending is going to slow. I mean, it is unreasonable to assume current levels of spending and the same amount of services spending continuing to drive growth in the economy. But
Sure.
yeah, I mean, these are all questions that are going to lie ahead. The Fed does want to see a slowdown in spending, surely. So we do know that they want to see pain. They told us. They told us that they want to see pain.
Right.
So
Right.
we might as well accept that
Sure.
that that argument that they laid out.
And speaking of pain, we really haven't seen too much extreme pain in the credit spreads, and especially the nominal yields. Why don't we dip into that a little bit?
Yes. So as we spoke about in the past, the credit spreads, meaning the difference in yield between a non-risky security such as the treasury yield, such
Yep.
as 10-year treasury yield, and the rate that corporations need to pay on their own debt, that that those credit spreads have remained extremely well behaved. And we look at high yield, we look at top-notch investment grade vehicles, and all of them across the board have not shown any financial stress. I mean, when we think about the Fed's financial stability mandate, which tries to address the functioning of financial markets first and foremost, credit, because it is the biggest market. That's what makes the wheels of the economy spin.
Yep.
Those spreads have remained extremely well behaved. But then we turn to nominal yields, and we do know that, especially as central banks globally kept their interest rates near the zero bound, companies have basically gotten zombified, and business models that would not work in a higher cost of capital
Right.
environment, such as we're
Yeah.
seeing right now, those sort of flourished, and investors put money into these lottery tickets, and right now they're reevaluating whether that is still a feasible investment idea in a world where maybe nominal rates are going to be a lot higher. So
Right.
if you were levered as a company before we came into this increase in cost of capital, then you're just paying that much more right now. And that's going to be something that these companies will have to address. And maybe some of them will need to go out of business,
Right.
which in turn would have a positive impact on the wage price dynamic that the
Yes.
Fed is so closely watching. So they need to keep the cost of capital relatively elevated for the labor market to loosen, for the wage price dynamics to ease, and ultimately for inflation to come in. They are telling us their playbook. They told us that they want to hang out at a higher nominal level on rates for quite a while until some of these pressures ease. And as they clearly stated, the risk of overdoing it is much less than the risk of not doing too much in response to what we're seeing in the economy.
Right. I mean, at the end of the day, how can a business model remain solvent when you have an extra 500-600 bips of an increase in your debt servicing?
Yeah, and just imagine if you run a business and before all of this increase in rates happened, and say you paid 400 basis points of your aggregate revenue and interest service, and right now that rates are maybe 4 times as high, you all of a sudden pay 1,600 basis points in interest service. So business models do work in some environments, and one needs to realize that the last 2 years and really the last decade or so, ever since QE started in the US, that was the anomaly. That is not the norm. And companies got accustomed to that anomaly, and there will ultimately be a cleansing process unless we return to a pre-COVID economy, which we do have to entertain the possibility of. But right now, things just don't look as bright as they used to.
Yeah, that is very true. I think we can end it with this. Is there anything else we should be looking forward to before the meeting on Wednesday, and especially the rhetoric from Jerome Powell after that meeting?
Yeah, so we will be watching the Schultz job openings coming out tomorrow.
Yep.
We saw a big drop off of 1 million jobs from the job market the last time this reading came out. These are going to be September numbers. This number acts on a 2-month lag, but nevertheless, there were some divergences when the August number came out in, at the beginning of October. Decreased by 1 million, but then some higher frequency indicators did not really point to the same degree of slowdown that we might have seen in the Schultz number. But that will be a number really closely watched, especially as really wages are going to be the thing that they need to address. If the Fed wants to break the back of inflation, they need to decrease the demand of jobs in the economy so that the wage price dynamic does not get too entrenched before it's too late.
Yeah, and I believe the last time that number came in by 1 million, that was a big risk-on day for the market. I do remember that.
That was exactly it. I mean, if you see a loosening in inflationary pressures, that leads to a rollover in yields, and that leads to a market dynamic that's maybe a little more similar to what we saw on the back of coming out of COVID with low cost of capital, low inflation. And of course, markets are quick to extrapolate on just a single number, but then we have to zoom out. And that's why we titled today's episode Macro Mountain and Climbing the Macro Mountain, because we need to put all these things into perspective rather than focusing on just one number.
Well, I will be bringing my binoculars, my friend. Jannis Meindl, thank you very much. Always a pleasure joining you on Macro Corner.
Thank you so much.
Don't forget, guys, the Blue Line Futures chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to podcast@bluelinefutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and more. We will see you next week, everybody. Thanks again.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.